Good times don't last forever, and it seems like the Indian economy is starting to feel the weight of its own momentum. For years, we have heard that this is India's decade, a booming economy, foreign investors pouring in, and a stock market that seemed unstoppable. But now, things are not looking as smooth. Growth is slowing, consumption, the backbone of our economy, is showing cracks. Investments, both private and public, are not picking up the way that they should. And global factors, from China's economic moves to FII outflows, are adding to the uncertainty. So, has India turned a corner or is this just a rough patch? And more importantly, if India's growth slows, what should you do with your money? Let's take a closer look at the data. The latest GDP numbers tell an interesting story. After a shocking 5.4% growth in the second quarter, way below expectations, there was some rebound to 6.2% in Q3. But let's not get carried away. There is still significantly lower growth than the 9.5% growth we saw in the same quarter last year. Even if you look at the gross value added or GVA numbers, they show a modest recovery, but nothing extraordinary. And here's the thing, even though growth bounced back, it still remains way below India's potential. A country with a young workforce and rising aspirations should be growing at 8% or more, not struggling to maintain 6%. Consumption is where things get really interesting. Consumer spending accounts for a huge portion of our GDP. And while there has been an improvement, it is still not the kind of recovery you would expect in a booming economy. The numbers tell a conflicting story. Yes, overall consumption rose by 3 lakh crores in Q3, but when you break it down, urban demand has been weakening. Just look at car sales. While luxury brands are still seeing demand, two-wheeler sales, which is a key indicator of middle-class confidence, have slowed down. The real estate sector, another major driver of consumption, is also facing pressure. Top tier cities are doing well, but sales in tier 2 and tier 3 cities are nowhere close to where they used to be. And then there is the debt problem. RBI's recent curbs on unsecured loans, like personal loans and credit cards, are already showing an impact. People are borrowing less to spend, which means demand is slowing down. And when you combine that with high food inflation eating into disposable incomes, the picture is not as rosy as some headlines might suggest. Now let's talk about investments. Private sector capex, meaning how much companies are investing in expansion, is not picking up. And the government, which was supposed to drive spending through infrastructure projects, has actually reduced spending by 29,000 crores last quarter. This is a worrying trend because investment is what fuels long-term growth. If businesses and government both start holding back, who will drive the next phase of expansion? Even if domestic problems were not enough, India does not exist in a vacuum. First, there is China. After months of sluggish growth, Beijing is rolling out massive stimulus measures to revive its economy. This has two big effects. One, it makes China a more attractive place for global investors, drawing capital away from India. And two, it could lead to lower commodity prices, which might actually help some Indian businesses but could also hurt our export competitiveness. Then there is the foreign investor exodus. FIIs, who once could not get enough of Indian stocks, are pulling money out. Why? A stronger dollar, higher interest rates in the US, and the simple fact that emerging markets are seen as riskier in uncertain times. And speaking of the US, let's not forget about rising tariffs and trade restrictions. Protectionist policies, whether in India or abroad, could make it harder for Indian businesses to expand globally. So, what does this mean for your money? Here's the big takeaway. If your wealth and investments are entirely tied to the Indian economy, then you're exposed to all of these risks. Think about it. If global events are affecting your currency, your stock market, and your purchasing power, shouldn't you be thinking about global diversification? For years, people have hesitated to invest outside India, thinking that the Indian growth story was enough. But today, as India's growth slows and global factors become more unpredictable, having exposure to international markets is not just a luxury, it's a necessity. So, how to diversify your investments beyond India, staying in India? The easiest way to hedge against India's slowdown is to start looking at international investments. One option is the US market, which has some of the most innovative companies of the world. Funds like the Motilal Oswal S&P 500 Index Fund and the Franklin India Feeder US Opportunities Fund allows you to invest in giants like Apple, Amazon, and Google without needing a foreign brokerage account. Then there is China, which despite its challenges remains the world's second largest economy. Funds like Edelweiss China Offshore Fund provide exposure to China's economic recovery and its massive consumer market. International diversification is not about abandoning India, it's about balancing your risk. Just like you would not put all your money into a single stock, why put all your investments into a single country? So, is the India story over? No, but it is definitely at an inflection point. The long term fundamentals, Our young population, a rising digital economy, and entrepreneurship are still strong. But that does not mean that we'll see high uninterrupted growth forever. There will be slowdowns, crises, and global shocks along the way. The key is how you prepare your investments for these cycles. If you're serious about protecting your wealth, don't rely on India alone. Look beyond, think bigger, and take control of your financial future. Do you agree? Is India just facing a temporary dip, or is there something deeper at play? Let's discuss in the comments. And if you found this video insightful, subscribe to the channel and join my Telegram group for more discussion on investing and market trends. See you in the next one.